for them and for anybody else. There is Tanzania. So that gets us all the everybody who hadn't told me they would not be here. So, all right. So we're going to look at the homework uh, in detail, make sure that we know uh, how it should be completed, because not only are you have the opportunity to make corrections to your homework if needed, it will be great preparation for our midterm exam, which will be available shortly after this class ends, or maybe today, or maybe just as it ends, depending on how long it takes us. So that will be available in the Dropbox today. So I'm going to share my screen and we're going to look at the working through the homework in an Excel spreadsheet, similar to what we did in our demonstration in class on Tuesday. So let me, oops, where's my cursor? So question asked us to figure out break even per unit. So first of all, we need to calculate our contribution margin per unit. So our sales price was 15. They lumped all the variable costs together. They didn't break them out in the kind of detail I did in our example on Tuesday, making our life even easier. Okay. So it's $3 for variable costs. So if we take on a per unit basis, 15 minus 3, we get $12 contribution margin per unit. We had total fixed costs, and this is per year instead of per month, like our example, but no difference in the way we calculate it. We just need to think of it and label it as a per year concept rather than per month. $120,000 of total fixed costs. Again, they didn't break it down. They just gave us the total. So we divide the 120,000 by the 12, getting us a nice round 10,000 break even point in units. In dollars, we would simply, if this had asked the dollars, we simply could multiply the number of units by the sales price. All right. So that is your in units and in dollars. Now, if you did it using the contribution margin percent for the dollars, you could have calculated your contribution margin percent as 80%. Now, this was not required. Okay, so don't worry about it if you didn't do that answer. I'm just trying to be thorough, make sure that you see all the different ways that it could be accomplished. So you see how they all relate together as much as anything. So that would give us a STIN divided by the fixed cost divided by the 80% would give us 150,000. So we got it the same amount both ways. Now then, question asked us to be able to do it with a $50,000 per year profit. I mean, it's not good enough just to break even, right? Okay. So if we do that, we add the 50,000 to our 120,000 of fixed costs. And we take that and divide it by the 12, the same contribution margin per unit as we used before, to get 14,167 units to sell to make $50,000. All right. Then they asked how much sales in dollars have to get $70,000 of operating profit for the year. So now we take the fixed cost of 120 and we add in 70,000 for 190. We go back to this um, idea of either we use it because we're doing the dollars, okay? In this case, we can either divide 190,000 by 12, all right, the contribution margin per unit. I mean, that will give it, and then multiply by the sales price, 15. So we divide by 12 and then multiply by the 15, which is this formula up here. And if you did it using the contribution margin percentage, you take the fixed costs divided by the 80%, or fixed cost plus the target profit, 190,000, divided by the 80% contribution margin percent or contribution margin ratio. So either way, you get 237,500. Now, the question then asks for margin of safety. But in looking at this, realize that it's not clear at what level you were being asked to calculate the margin of safety. Was it at the enough to make a target profit of 70,000? If so, if you did it that way, your margin of safety is 5833 because the number of units you're selling is 5,833 more than your break-even point of 10,000. If you thought of it as a margin of safety based on the base case, the 12,000, since the break-even point is 10,000, we're 2,000 over the break-even point, or $30,000 in sales over the break-even point. Okay, so depending on how you read the question, again, you don't need necessarily correct it. If long as you did one or the other correctly, then you're good. Now, we were asked to prepare a contribution margin income statement for the base case. So that means we have sales of 12,000 times 15. 12,000 units was the base case, as it said in the problem, $180,000 in sales. Variable cost is $3 times the 12,000. So our contribution margin is 144,000. 180 minus 36. Then we subtract out the total fixed costs, right, which were given to us. And our operating profit is 24,000 at the base case. All right. So they wanted us to do that in preparation for, of course, doing some sensitivity analysis and saying, what happens if the sales price drops 30%? So assuming we sell the same 12,000 and our sales price drops by 30%, a couple different ways you can do that. You can calculate 30% off of 15 and then multiply it by 12,000. You can take 12,000 times 15 and then multiply by 0.7, which is same as subtracting out 30%. Whatever way you do that, your sales should be 126,000. That's a 30% reduction in the sales price. Now, the way it's stated here, sales stayed the same. We would hope in real life that if we were lowering the price, that we would be able to increase our sales in units, right? I mean, that would be the way. You put it on sale so you can sell more. But that's not what they gave us. But that would be traditionally more of what we would see in a real life setting in terms of what we might consider is, if we lower our price 10 or 15, 20%, whatever percentage, will we be able to sell more enough to be able to still improve our profitability? In this case, because this variable cost per unit is still $3, and because we still sold 12,000 units, our variable costs are exactly the same as they were in the base case, giving us a contribution margin of 90,000 instead of 144 like they were in the base case. Fixed cost stays the same, of course, because it's not dependent at all on volume or on sales price or anything like that. And we actually have an operating profit of -30, or if you wanted to change that and say operating loss, that would be even more correct, if you will, for 30,000. So you actually are losing money. You are below break-even point because of the reduction in the sales price. And that's what you would anticipate, right? If you somehow reduce your contribution margin, and that's what this is doing. Any reduction in sales price is going to reduce contribution margin. You would expect there to be a drop in our operating profit unless we can increase the sales enough to cover. So the second sensitivity analysis or change that in the variables they wanted us to try didn't affect sales. So notice that our sales are the same as back here in the base case. But instead, our variable costs are going to go up by 10%. So the easiest way to make something go up by 10% is to multiply it by 1.1. But you can always multiply it by 10% and then add it too. You can do that to the cost per unit and then multiply it by 12,000, or you can multiply it, make it for the whole amount. Either way, you're going to get 39,600 for your new variable costs. Not because the units went up, but because the cost per unit or the went up. That gives us a contribution margin of, instead of 144,000, 140,400. So it dropped by that amount. Basically, see, about 3,600, and then subtract out the same fixed costs, and our operating profit, as we would have expected, is reduced because of the increase in our costs from 24,000 to 20,400. All right. So question then, if this was real life, then the thing is, if we have this cost increase in our variable costs, what do we do with our sales price to maybe make up for it? How much do we need to increase? Can we increase our sales price enough to get our operating profit back to where it should have been in the first place without hurting customers, making our sales price too high such that customers will leave? All right, questions about anything having to do with problem 32? Everybody's comfortable with that? All right. Speak up if you have a question. All right, moving to problem 35. This is actually, as labeled, a service company, but it also has two products. And therefore, our information is given to us not in per unit basis, but in a total basis. So we kind of have to approach this a little differently to get the answers that we need. So it's going to ask us break-even point in sales dollars. Because there's no per unit costs and such, we couldn't answer the question break-even point in units. But we can in dollars. First of all, we calculate the contribution margin percent or ratio at 0.75 or 75%. And the way we do that is we take the total contribution margin off of our contribution margin income statement and divide it by the sales. So 1.125 million divided by 1.5 million equals 0.75. We take our fixed cost of 600,000 and we divide it by the 0.75, and we get $800,000 break even in sales dollars. So as we look back at our base case that they gave us, we're well above break-even point, right? Because our sales are 1.5 million and the break-even point is 800,000. And yes, we look at our operating profit and it's fairly significant, 525,000. So we are over our break-even point by 700,000. So that's our margin of safety. And again, because we don't have per unit information, we can't do that on a unit basis, only on a sales dollars basis. So we're at 1.5 million, our break-even point 800,000. So we're margin safety 700. Then they want to know if what we need to do if we want to make 750,000. See, our base case, we only made 525. What if we wanted to increase that to 750? Then we add that to the fixed cost of 600. And we get 1,350,000. That's our desired profit plus our fixed costs. We divide that by 0.75 and we get 1.8 million or 1,800,000. So that is the sales dollars required to earn an annual profit of 750. All of this is on a per year basis. So going back to this base case that they provided for us, they already did the income statement on a contribution margin basis. Then they ask us to do it if the operating profit for variable costs, what would happen if our variable costs are 20% higher than originally anticipated?
I have a question on that.
Go ahead.
I thought it specifically said only the commercial was 20% higher.
Oh, you did?
That's what I thought it read.
I can
Yeah,
see
that's what I
that.
did too.
All right, let's change that. Let's see. That's not hard. Let's take that out of my residential. I think you're right. I think looking at it again. All right, so that should flow through there. Okay, so that should change our result here. So yes, if you read that more carefully, commercial variable costs are 20% higher. So they only change the variable costs on the commercial. And again, to do that, you just multiply by 1.2 is the easiest, or you can multiply by 0.2 and add it, whichever. Total variable cost 430, contribution margin 1,070,000, fixed cost 600,000, and our operating profit went down as we would anticipate, just like before. When our variable costs go up, our operating profit is going to go down. All right. So glad that you caught that and were paying attention. Got the fact that it was just the commercial.
I have a question.
Go.
So for the variable cost for total, you just add 100,000 and 330,000 then? Because I did it differently. But
just 100 plus the 330. Yes, gets you the 430.
Okay.
Okay.
All right.
How did you do it?
I thought that we were supposed to get 20% of it, like how we did for the 330. So for that, I did. What did I do for that one? I forgot what I did, but yeah.
Well, I mean,
never mind.
If you did the multiply by 1.22 over on this total, then you're applying the 20% increase to both commercial and residential. But I think if the question, and again, that's not, I can see, it's pretty easy to miss that, but the commercial is what it should only apply to the commercial part of it. That's why it's easier to see when it's separated out this way.
Okay.
All right. So it asks you, what does this do? What does this change in variable costs do to our operating leverage? And remember, operating leverage is the relationship between variable and fixed costs. So anything that increases fixed cost would make you more leveraged. Anything that would increase variable costs while not affecting fixed costs would make you less leveraged. So this was an increase in variable costs with the same fixed costs. So it makes us less leveraged. Okay. And if it would have been an increase in fixed costs with no change in variable costs, typically we think of it as a change in, there's something happened going in both directions, meaning the increase in fixed costs means a decrease in variable costs or vice versa. And so the leverage question is clearer, because if you increase fixed costs and reduce variable costs, that makes you more leveraged. And if you're making fixed costs go down and your variable costs go up, that makes you less leveraged. Okay. And I'm going to do another example that wasn't assigned on the homework, but to illustrate that in more detail in a minute here. Any questions, other questions other than my mistake on the variable costs about this problem? All right, so you see any corrections you need to make, get that all ready to resubmit, that sort of thing. Okay, now I've got two problems that were not assigned, but I want to show them to you so that you just get more reinforcement of the concepts that we're talking about, since they're going to be so important on our midterm exam and so forth. Okay, so if you want to go back and look at this, this is problem 37 in the textbook, but it illustrates the idea that we hit on at the very end of class on Tuesday, the difference between variable costing and what we call traditional costing or absorption costing. Now, the idea of absorption costing is all of the costs go into cost of goods sold. And we did that. That's what we did when we first learned in chapter 1. Into chapter 2, we were talking about, when we consider what costs went into cost of goods sold, we included direct labor, direct materials, overhead, and that included both variable costs and fixed costs in that overhead. And if we were going to do it on a per unit basis, we just took the fixed costs and divided by the number of units. So that's how it is required to be done for US GAAP. That is the traditional, and it's referred to as absorption costing, meaning all the units have to absorb some of the overhead, especially the fixed overhead. It's never really controversial whether to do the variable overhead. It's that fixed overhead that is also included, but also is kind of hard to see, because while it is a fixed cost, we're doing everything on a per unit basis, even though those costs are not changing per unit. So this is traditional. The problem states that gives us the variable costs, all right, per unit. It tells us that direct materials were $8, direct labor is $3, manufacturing overhead is $4 variable, just like I broke it down when we did it on Tuesday. Our fixed production costs are $1 million per year. So we treat that as $5 per unit because we're making 200,000, right? And then there's some variable selling administrative costs and fixed selling administrative costs, which are all part of the selling administrative costs here. All right, the variable and the fixed part. So in the year 1, we made and sold exactly the same number of units. We made 200,000, we sold 200,000. So the cost per unit is $20 if you include all the variable costs and the fixed costs on a per unit basis. So some of the fixed costs are in cost of goods sold, or actually for the whole 200,000 are in cost of goods sold. Now, in year 2, our cost of goods, we sell 170. We still make 200,000. Each year we made 200,000, but in year 2 we sold fewer. So notice how cost of goods sold goes down, right? Because we're talking cost of the units that were actually sold, not the cost of the units that were made. And selling administrative also goes down because it's fixed, but some of it is selling administrative is variable. We only have to pay it out $2 for the 170,000 units we actually sold. So our actual operating income is 560 for traditional. All right. And in year 3, we still make 200,000, but this year we sell 230,000. We sell more than we made. So you see how our sales go up. Cost of goods sold, again, is based on the number we sold, not on the amount we made. All right. And then selling administrative is based on the sales and the 800,000 fixed costs. So gross profit is higher, operating income lower. Now, if you look at this, our operating income for the 3 years is 2.4 million. I just added straight across the operating income. All right. And I'll come back to that in a minute as a comparison. Now, if we use the variable costing using the contribution margin format that we've been focused on in chapter 3, and our made and sold are the same, notice we come up with the same operating income. Everything just kind of gets rearranged a little bit. Variable costs are 3.4 million because we include everything's variable, including variable selling costs. And our fixed costs are the $1 million fixed overhead and 800,000 fixed selling administrative. So as long as our amount we made, the amount we sold is the same, our traditional version and the variable version or the contribution margin version gives us exactly the same operating income. All right. And so that's kind of how we first introduced the concept of these two, is that they would give you exactly the same. However, in a year that you made more than you sold, you're going to actually have a lower operating income because instead of some of your overhead that's fixed being assigned to the ending inventory. See, at this end of this year, year 2, you made 200,000, you sold 170,000. That means 30,000 are still in inventory, right? If you made them but didn't sell them, they're sitting around in finished goods specifically. All right. Those finished goods under the variable costing do not have any fixed overhead assigned to them. Okay. All of the fixed overhead is treated as happening this year. Okay. So the fixed overhead is really based on how much is made, not on how much is sold. So it's higher than it would be if you based it on what you sold, which is what's up here. That means we're going to have operating income, in this case, of $150,000 less. And that's exactly the fixed costs that would be, okay, in our ending inventory, because 30,000 units, $5 was our fixed overhead per unit. That's 150,000 difference. All right. Now, just the opposite thing happens. In year 3, when you sell more than you make, again, it's not equal. The operating income using the variable costing method or variable and the contribution margin method, outline, variable costs, all good, easy to calculate. Contribution margin, again, the fixed costs are not based on the extra that you made or sold. They're just the same as they were every other time. Fixed costs are fixed. So it wouldn't matter what we sold, especially since we made the same each year. And so our operating income in this year is higher when we sell more than we made than for the variable costing than it is for the traditional or absorption costing. What I want to show you is because we were off by 30,000 here and off the other direction 30,000 here, the total operating income for the 3 years is exactly the same for the two methods, but different from year to year. All right. So many companies utilize this internally, which means it has to be adjusted or they're going to report the wrong thing externally, which is what is required up here. So that's kind of the important thing to remember. While this may give us better information about what is changing based on our volume, because we are focused on these variable costs and we recognize that the fixed costs we have very little control over, regardless of whether we make or sell more or less, they're going to be the same. That's why we do it this variable way internally, because it's basically an admission that we can't really control those fixed costs on an ongoing basis, at least in the short run, certainly not by making more or less of our product. Questions about that? Okay. So kind of an important real life concept in the sense that you need to know that there are two ways that people are talking about looking at our operating income, and that making how much we make versus how much we sell can have an influence as to whether or not what we're looking at in terms of our operating income levels. All right. So that's problem 37. If you want to go back and review that at all. And then I have one more that I want to help us understand this concept of leverage a little bit more. And this is problem 39. If you want to go back and look it over. But basically what we're talking about is a company that makes one product, but they're considering whether or not they should use the labor-intensive process or an automated process. So this is the same product, looking at it in two different ways. So that's why the sales price is the same. So the idea is the customer doesn't care how you made it. If you made it with a machine or maybe you made it with people, they're going to say this, pay the same price either way. So under the labor intensive process, our variable costs are $500, $490 for variable costs such as materials and labor, and $10 in selling costs. The automated, it's $290 for materials or direct labor, that sort of thing, and overhead, and $10 as well for variable selling, because you wouldn't expect the selling costs to be different whether you did it with a labor process or an automated process. So under the labor intensive process, it's 400,000 contribution margin, automated 600,000. But under the labor intensive process, you don't have as much fixed costs. You don't have as much overhead, if you will, for running machines. All right. The employees do a lot of the work. but they are more of a variable cost than a fixed cost. But if you do it automated, you have a lot of fixed costs that have to be spent regardless of volume on the machines, whether it be programming, whether it be maintenance, whether it be other things that go into running those machines. So we have obviously some very different levels, almost more than double under the automated system. So we do the same idea as we've done anywhere else. We take our fixed costs, we divide it by the contribution margin per unit. We get a break-even point of 3,500 for a labor intensive process, and we get 5,000 for an automated. So this is a perfect illustration. This is a low leverage scenario. Lots of variable costs, not as high fixed costs on the left-hand side of the labor column. And see how much lower the break-even point is, 3,500, versus this highly leveraged or more leveraged automated with more fixed costs, but lower variable costs. So then the question is, what do we prefer? Do we prefer a lower break-even point or a higher break-even? Well, typically we're looking for a lower break-even point, but that has some issues going forward, and that's what we want to look at for next. Okay, so I built the contribution margin income statement using both methods. Sales of 7.2 million, which is at 8,000 units. So I just took the 8,000 units times 900 for both sides, took 8,000 times the variable costs, got contribution margin, got my fixed costs, which of course are the same regardless of how many units I make. And then I have my operating profit is exactly the same at 8,000. Now the problem asks if your sales are going to go up next year from 8,000, what would you prefer to be? Labor intensive or automated? So I'm going to, and why? So I want to put that out to you. I've given you the calculation, showed you the looking, if you're going to increase sales, what's going to happen using the two scenarios? Anyone? What would you prefer? Labor or automated? This is the kind of decision that we use this information for. Nathan, you got any ideas? Tanzania? Alexandra? Anyone?
So would we want it automated?
Why? What? I mean, yeah, you got only two choices. That's true. But which one? Why would you think that?
Because the fixed costs are more.
Okay. Let's see what happens. Let's go ahead and do some calculations. I think Nate may be onto something here. Okay. All right. So if my sales, let's just increase our sales to 9,000. Okay. So if I take 9,000 and I multiply it by 900, and then I take my 9,000 and I multiply it by my 500 for my variable costs, I get a contribution margin of 3.6 million. It's up from the contribution margin at 8 million, just like we thought it should. And then my fixed costs, of course, are going to stay the same. And so my profit or operating profit is going to be 2.2 million. It's increased. That's good. That's what we would expect under the labor intensive process. Now, let's see what happens on the automated side. Sales, of course, are the same, but variable costs, while they go up, they don't go up near as much. And our fixed costs, assuming this is still part of the relevant range and we haven't exceeded that, is still 3 million. So my operating profit is higher using automated, just like Nate suspected. All right. Because once you reach break-even point, or once you have reached, your profit goes up more using a leveraged, which is what automation is typically, because your fixed costs continue to stay the same. And your contribution margin is going up faster. Why? Because you have lower variable costs. So this is an example automated of a more highly leveraged than the labor intensive process. If you were concerned that your sales were not going to go up, or they might go down, then you would be more likely to want to be labor intensive, because if your sales go down, then your profit on the labor side is going to be higher than automated, because it's going to go down on the automated side faster. It's more highly leveraged. All right. Think of it in terms of, you might say, the example I often use is a seesaw at the playground. How far up or down you go depends on how far you are away from the middle, right? If you're very close to the middle, you don't move that much up or down. If you're a ways away from the middle, clear on the end, you go up or down high a lot. High leverage means you go up or down, have good highs or lows a lot. Low leverage means you're closer to the middle and you don't go up and down as much. Not as high a risk, but not as much fun, many people would say. Okay. All right. Questions on any of those problems? All right, then let's talk a little bit about the discussion posting. We've already had some weigh in on the discussion. All right, we are looking at a discussion having to do with Subway. All right, and most of us have heard the advertisements of their $5 footlong promotion once in a while that they come out with in order to do that. Now, Pamela in her posting mentioned something that just to kind of let everybody know, she made the connection or the supposition that $5 footlong is a loss leader, meaning they purposely set the price low so they can get people in the door with the idea that they can sell you something else as well. All right. That may be true. All right. But seldom do companies actually sell it anything for less than it actually costs them. But they may have a very low profit margin on certain things. Usually a loss leader is typically not an actual losing money as much as it is a much lower profit than we typically experience. All right, so you're in this discussion, you are going to see a list of cost items and determine whether they are fixed or variable or mixed. All right. And some of you have already weighed in on that, and most of you are pretty close on those. So in terms of that, I will tell you as you go through it and as you post, then you'll be able to see other people's posts. You certainly are welcome to go back in and update your posting in any way. If you see that someone, that someone disagrees with the nature of a cost and you say, oh, I think they're right. I think I see that now. I think that's fixed rather than variable. There really is, according to the information, only one cost that's a mixed cost, and that's the credit card transaction fee, just so you're don't get too carried away on the mixed, because there is a percentage of the sales part of it, and there is a 10-cent per transaction. And when we're looking at on a per unit of the sub, that 10 cents is a fixed cost. Okay, so when you thinking about that, that's a fixed cost, not the variable one is the 1%. So rest of those are at least as they're given to us. All right. So you may disagree with, say, what in general rent might be or electricity, but as it's given, they're given as a particular way. So you're going to have to go with what's given. Now, when you think about this concept and the ability to, set a price for a product, you need to make sure to cover your variable costs. That's what you're trying to see to figure out your contribution margin. And your contribution margin, when you cover variable costs, should be positive. All right. So if you come up with a contribution margin that's negative, I want you to rethink your fixed and variable costs so that it should at least be a positive contribution margin. So what that means is that with every sub they sell, they actually collect more than the costs that the increased costs for doing one more sub. And so in many ways, the fixed costs and trying to make sure that $5 sit-longs cover all the fixed costs doesn't make a lot of sense, because you have a lot of other products that can also be used to cover those fixed costs. So that's kind of the thinking behind running a loss leader or a special or a sale on a particular product, is you can lower it down to the point where maybe you're not covering all your fixed costs, but you're covering your variable costs, and therefore you're still okay, and you could bring in more customers that will buy other things that will help cover the fixed costs. So think about it in those terms as you answer the questions. And it's one of the real big reasons why it's so important to understand which costs are variable and which costs are fixed, to know which ones we have to, because if you are not covering your variable costs, then you should stop selling a product now. Because if your sales price is $5 and your variable costs per unit is $6, every one you make and every one you sell is digging you a bigger hole. And no matter how many you make, no matter how many customers come in and buy that product, you are in deep trouble. Okay. And you should stop right now. You should close your doors and not let anybody come in, because you'd actually be better off just covering your fixed costs by taking out a loan than you would by making your product. So that's a pretty serious situation to be in, where your variable costs are higher than your sales price. So we're not in that situation here. If you move your cost in the right direction towards fixed or variable costs. Now, that doesn't mean you can ignore fixed costs forever, right? Because as a whole, all of your products need to cover fixed costs, or yes, you are still going to have negative operating income, and eventually you're going to go bankrupt. All right. So you do have to cover fixed costs eventually. Now, part of the reason why I kind of bring this up in more detail, so you start thinking about it, okay, is these types of decisions, like, do we run a special on $5 footlongs, are the kind of decisions we're going to discuss in detail in chapter 4 when we go on to the next section. And we're going to encounter multiple decisions and that come up all the time in real life, in real businesses, as to how they consider pricing, what products they should sell to whom, that sort of thing. And this is just a kind of a good example to kind of a bridge from what we've talked about in chapter 3 into what we're going to talk about in chapter 4. So any questions about that? So remember, it's not about just plunking down the right answer, talking it through, responding to other ones. That's why I encourage you to post on there quickly so that others can respond to it. You can get some feedback. There's already some posts there you'll be able to see as soon as you post. All right. And then you can work through and get a robust kind of discussion. And I've made some comments back to a couple of those who have already posted.
Well, we discuss this maybe next Tuesday. I really would like to hear what the final thought was, or what your thought is.
Well, we'll see how it goes, but I think we're going to come to, I think with that guidance, I think there'll be some good consensus and such, and I will make comments to indicate where we're going the right direction and so forth, and what I think the ultimate there's not a right answer as much as there is some. I just want you to be thinking through the process in a meaningful way. So I will nudge you in the right direction if you get too far off.
So if you post the exam today, we're gonna have the classes next week, or are we gonna take one off?
No, we will go forward with class in the same schedule.
Okay.
We don't have time to give you a whole, much as I might like it, to give everybody a week to work on the exam. So it will be working on that, and then we'll move on to the same time onto chapter 4 on next Tuesday. So you'll have to split your time between working on that exam and getting prepared for Tuesday's class by doing some reading. Any other questions? I have put a discussion board in module 3 and reference to it in module 4 that allows you to ask questions about the midterm exam. The midterm exam should be entirely your own work. So if you have questions about what's being asked or any of the details or anything like that, please post in that discussion board where I can answer in a way that it would be available for everyone. So it would be everyone will benefit the same way from asking and answering that question. Do not worry that that is cheating or considered not doing your own work. I will answer in a way that will make sure that it's not cheating and so forth. But that's how I would like you to, if you get stuck or have a problem to deal with it, please, is post in the discussion and don't be concerned that no one else has that question because chances are they do. So. Any other concerns or questions or thoughts? So you should have time now to go and post, to also make your corrections to your homework if necessary. All right. And even at 2 o'clock, be able to access the midterm exam and start looking at that as needed. Other than that, I don't have any more to cover, so give you the rest of the time to work on those items. If you have further questions, please stick on class as usual. I will stick around until everybody is gone to see if there's any questions.
Thank you.
Thank you.
Have a good weekend.
You too, Pamela.
I have a question.
Go.
So I'm looking at the discussion right now, and I don't know why I keep getting confused with like the sale cost. So I see that the cost per foot long is $5.37. Would I also add that to the food ingredients that's $2 or no?
No, that $5.37 is everything listed added up.
Okay. Okay.
But that includes fixed and variable. So that's not something you can, I'm telling you, you should trust, because that whoever came up when they did the 537, they didn't try to separate out fixed or variable. That's everything.
Okay.
So that's not, I won't say it's a wrong calculation. It's just it's added up correctly.
So I shouldn't use that. I'm sorry.
But
So I shouldn't
that
use
should
that.
not be the number you use to do
Oh.
your contribution margin or something like that.
Yeah.
Okay, does that make sense?
Yeah.
Okay.
And then for the exam, so is that due next Thursday since we have a week? Or
Yep, you have a week to work on it.
all right. Thank you.
Sure. Have a great weekend.
You too. Bye.
Bye-bye.